You might be wondering about UnitedHealth Group with their stock down yesterday.
It is a little strange to see a stock dip when the market is doing well.
Yeah, it closed at $608.52.
Down 0.28%.
But the S&P 500 was up.
It was up 0.25%. The Dow had a slight loss, but the Nasdaq had a significant gain.
But the picture changes when we look at the past month.
Over the last month, UnitedHealth Group stock is up over 7.5%. It's actually done better than the medical sector and the S&P 500.
The medical sector had a loss over the past month.
It did. And the S&P 500 gained 3.5%.
So maybe the dip is temporary.
It's possible, but we should look at other information before we jump to conclusions.
Like their upcoming earnings report.
Exactly. Analysts are projecting earnings per share of $6.74.
That's a big increase from last year.
It is over 9% growth year over year.
And what about revenue?
The estimate is $101.71 billion, a 7.5% increase.
That sounds like the business is doing well.
These are just projections, though. We'll have to wait and see how the actual report turns out.
Let's look at the full-year outlook since we're talking about projections.
Analysts are expecting earnings per share of $27.61 for the full year.
Almost a 10% increase from last year.
And revenue is projected to be $401.27 billion.
So the single-day dip might not be a big deal.
Not necessarily. There are a lot of factors that can cause a stock to go down slightly. It's important to consider the bigger picture.
What are analysts saying about the stock? Their opinions can be valuable.
They can be. They issue ratings and make predictions about how they think a stock will perform in the future. Their earnings estimates are also really important.
How much they raise or lower their projections.
Yeah, positive revisions to earnings estimates often mean the stock will go up.
So if analysts are optimistic about UnitedHealth Group, that's a good sign.
Generally speaking, yes, although there are always exceptions.
What is the current analyst rating for UnitedHealth Group?
Right now, it has a Zacks rank of 3, which is a hold recommendation. It's not a buy signal, but it's not a sell signal either.
So a neutral stance. What about valuation?
Valuation is important because it helps us understand if a stock's price is justified based on the company's financial performance.
One metric we can look at is the price-to-earnings ratio, or PE ratio.
Right. UnitedHealth Group's forward PE ratio is 22.1.
How does that compare to the industry average?
The average for the medical HMOs industry is 12.71.
So UnitedHealth Group is trading at a premium.
It is. Investors are willing to pay more for each dollar of UnitedHealth Group's earnings compared to other companies in the industry.
It sounds like they're betting on UnitedHealth Group's future.
That's one way to look at it. They might be considering factors like the company's size, its market share, or its potential for growth.
You mentioned another metric called the PEG ratio. What is that?
The PEG ratio takes into account the company's expected earnings growth. It gives us a better sense of whether the stock is overvalued or undervalued relative to its growth potential.
What is UnitedHealth Group's PEG ratio?
It's 1.79.
And how does that compare to the industry average?
The average PEG ratio for medical HMO stocks is 1.03.
So UnitedHealth Group is above average again.
Yes, which suggests that investors are expecting strong growth from the company in the future.
It seems like the market is optimistic about UnitedHealth Group's future.
It does, but we should also consider the industry as a whole.
The industry's performance can impact the stock price of individual companies. So how is the medical HMOs industry doing?
It's currently ranked 59th out of over 250 industries by Zacks.
Which puts it in the top 24%.
Exactly.
What does that mean for UnitedHealth Group?
It's a positive sign. It means that the industry is relatively strong, which is good for leading companies like UnitedHealth Group.
So even though the stock dipped yesterday, the long-term outlook for UnitedHealth Group seems to be positive.
It does. The company is performing well, it's expected to continue growing, and it's in a strong industry.
It's important to remember that the stock market can be volatile in the short term, but the fundamentals of UnitedHealth Group appear to be solid.
I agree. It does.
So what are some of the possible explanations for the dip?
Well, sometimes investors sell stock after it goes up a lot.
To take profits.
They want to cash in on their gains.
That makes sense. It had a strong run over the past month.
Exactly. And there might have been some news or rumors that made some investors nervous.
About the industry or the company specifically?
Possibly. Or maybe they're concerned about upcoming policy changes or new regulations.
It seems like there are a lot of things that can cause a stock to dip, even if the company's doing well.
There are. And we have to remember that the stock market doesn't always reflect reality.
But it seems like UnitedHealth Group is doing well overall.
From what we've seen so far, yes.
Their size and market share must give them some advantages.
Definitely. They're the largest health insurer in the United States, which means they have a lot of negotiating power.
With hospitals and doctors.
And with drug companies, too. They also benefit from economies of scale.
What does that mean?
It means that their costs are lower per customer because they have so many customers.
That makes sense. And they have a diverse business model.
They do. They're not just a health insurer. They also offer healthcare services and technology.
So they're not completely reliant on one source of revenue.
Right. That makes them less vulnerable to changes in any one part of the market.
So while the recent dip might have worried some investors, there's no reason to panic.
I wouldn't say so. Their long-term prospects still look good.
Let's talk about their valuation.
As you mentioned earlier, they're trading at a premium compared to their peers.
Which means that investors are willing to pay more for their stock.
They are. And that's because they believe that UnitedHealth Group will continue to grow and be profitable.
But is that a reasonable expectation?
It's hard to say for sure, but there are some reasons to be optimistic.
Like what?
Well, they're a leader in the Medicare Advantage market, which is growing rapidly.
Medicare Advantage is a private alternative to traditional Medicare.
That's right. And it's becoming increasingly popular with seniors.
So UnitedHealth Group is well positioned to benefit from that growth.
They are. They're also investing heavily in technology.
Which could lead to lower costs and better outcomes for their customers.
Potentially. And that could translate into higher profits for the company.
And they have a good track record of paying dividends.
They do. They've increased their dividend every year for over a decade.
Which is attractive to income-oriented investors.
Absolutely. It gives them a steady stream of income.
So it seems like there are a number of factors that justify their premium valuation.
There are, but it's important to remember that there are also risks.
Like what?
Well, the healthcare industry is complex and constantly changing.
And it's heavily regulated.
Which can make it difficult for companies to operate profitably.
And there's always the possibility of new competitors entering the market.
That's true, especially from technology companies.
So UnitedHealth Group will need to continue to innovate and adapt to stay ahead of the curve.
They will. And that's something that investors should keep in mind.
But overall, it seems like they're in a strong position.
I think so. They have a lot of things going for them.
Before we move on, I wanted to ask you about their commitment to social responsibility.
That's become an increasingly important factor for many investors.
They want to invest in companies that align with their values.
And UnitedHealth Group has been recognized for its efforts in areas like diversity and inclusion, community health, and environmental sustainability.
So they're not just focused on making money. They're also trying to make a positive impact on the world.
And that can be a differentiator for them, especially as more and more investors are looking for companies that are doing good.
It's good to see that they're taking these issues seriously.
It is. It shows that they're thinking long term.
About their impact on society as a whole.
Exactly. They're not just focused on the next quarter or the next year. They're thinking about the next generation.
And that's important for a company that's so deeply involved in people's lives.
It is. They're not just selling a product or a service. They're providing healthcare, which is essential for human well-being.
So their commitment to social responsibility is not just a PR move.
It's not. It's part of their DNA.
Now let's shift gears and talk about the broader healthcare landscape.
It's a complex and constantly evolving industry.
And it's facing a lot of challenges.
It is. One of the biggest challenges is the rising cost of healthcare.
Which is a concern for everyone.
Consumers, employers, and the government.
What are some of the factors driving up costs?
Well, one factor is the aging population.
People are living longer, which is a good thing.
It is. But it also means that there are more people who need healthcare.
And as people get older, they tend to have more health problems.
That's right. So the demand for healthcare services is increasing.
And the supply of healthcare professionals isn't keeping up.
Which drives up costs.
Another factor is the increasing use of technology.
New medical technologies are amazing.
They can save lives and improve quality of life.
They're also expensive.
And the development of new drugs is very costly.
It is, and drug prices are a major contributor to the rising cost of healthcare.
So what can be done to address this problem?
That's the million-dollar question. There's no easy answer.
But there are a number of things that are being tried. Well, one approach is to focus on preventive care.
The idea is to keep people healthy so they don't need as much expensive treatment.
That makes sense.
And there's also a lot of interest in using technology to make healthcare more efficient.
Like telehealth.
Which allows patients to see doctors remotely.
And that can save time and money.
It can. And it can also improve access to care for people in rural areas.
So there are some promising developments.
There are. But it's going to take a lot of effort to bend the cost curve.
Another challenge facing the healthcare industry is the increasing regulatory burden.
There are a lot of rules and regulations that healthcare companies have to comply with,
And those regulations are constantly changing,
which can make it difficult for companies to plan and make investments.
and it can drive up costs.
It can. The cost of compliance can be significant.
So the balancing act?
It is. Regulators want to protect consumers and ensure that healthcare is safe and effective.
But they also need to be careful not to stifle innovation.
Too much regulation can make it difficult for companies to develop new treatments and technologies.
So it's important to find the right balance.
It is. And that's something that policymakers are constantly grappling with.
It sounds like the healthcare industry is facing a lot of headwinds.
It is, but it's also an industry with a lot of potential.
The demand for healthcare is only going to increase in the years to come.
As the population ages and as new treatments and technologies are developed,
So it's an industry that investors should pay attention to.
they should. It's an industry that's going to be in the spotlight for a long time to come.
So we've covered a lot of ground today. We talked about UnitedHealth Group's recent stock performance,
Their upcoming earnings report.
analyst ratings, valuation.
We also touched on their commitment to social responsibility and the broader trends in the healthcare industry.
Given all of that, what are the key takeaways for our listeners?
I think the main takeaway is that investing is never simple.
Especially in a complex industry like healthcare.
Right. There are so many factors to consider.
And the market is constantly changing.
So investors need to do their research.
And be prepared for the unexpected.
They also need to be comfortable with risk.
Because there's no such thing as a guaranteed return.
And they need to have a long-term perspective.
Because the stock market goes up and down in the short term.
But over the long term, it tends to go up.
So if you believe in a company and its management team,
And you're comfortable with the risks,
then it might be worth investing.
but don't invest more than you can afford to lose.
And don't put all your eggs in one basket.
Diversification is key.
It's also important to remember that past performance is not a guarantee of future results.
That's right. Just because a company has done well in the past doesn't mean it will continue to do well in the future.
So stay informed
Do your research.
and make informed decisions.
And most importantly, don't panic.
The stock market is a roller coaster.
But if you write it out, you're likely to come out ahead in the end.
That's all the time we have for today.
Thanks for joining us.
We hope you found this discussion helpful.